I'm still here. Let's see if my camera works. Oh, slideshow. Oh, Terry, awesome. That's great news. Well, you know you are welcome to the Complete Trader as soon as it makes the most sense for you. I hope the move and all that stuff went as well as can be expected. All right, let's do camera. Excellent. Share screen. Sorry for the delay here. All right. I think you should all be able to see my screen. And I just realized that my plan is to take you inside the member area, and I don't have myself logged in, so let me do that. Okay. I think we are all set. Thank you for your patience. Let's get started. Welcome, everyone. This is Jeff Bish, president of marketgauge.com, and I have a brand new presentation, a brand new service. This is something that we have been working on for a very long time, and it's no joke when I say entitle it a new discovery in underappreciated data created a surprisingly successful trading system that beats the market by 2 times, 6 times, even 19 times. That's going to be your choice. That's all going to make more sense once I get into it. And before I can get into the details, I do need to let you know that I'm not a licensed financial advisor. And for that reason, access to this webinar is for educational and informational purposes only. Now, one of the cool things about this webinar is that one of the things you're going to discover is a system, a new system, a system that you have absolutely never seen before. And this trading system is represented by the blue line here. That would represent the equity of your portfolio if you were following this system. And the red line is the value of the S&P 500 or the SPY ETF. If you're not familiar with the SPY ETF, could you just throw a quick question in the questions box? What's the SPY? Not familiar with ETFs. And I'll make sure to explain that. Now, in this particular presentation, we're going back to 2018 because that's as far back as we did the testing. So all the data that I'm going to be talking about goes back to 2018. So we've captured, as you can see, the pandemic crash in 2020, as well as the ugly bear market of 2022. And as you can see, one of the really cool parts about this particular system is that in the 2020 crash, this particular version actually went up immediately. And then in the 2022 bear market, it sold off with the market for about the first couple of months. And then you can see it bottomed out in around March. And that was its low, even though the market proceeded to go down and make new lows in July, another new low in October. And so by the time the the market was just coming back up from its low in October, when everybody was completely convinced that any rally at that point was going to be another bear market rally to be faded. This particular model was basically breaking out to new highs. And so when I say surprisingly, I have to admit the source of this discovery surprised me as well. Now, not only did it surprise me in terms of its ability to outperform the market, but the consistency of trades is one of the kind of the secrets to the success of this system. We're going to dive into the members area. You're going to be able to see everything. And so this is just a screenshot of one of the models that we're going to see, and demonstrating that after 4 losing trades here in 2022, to be expected, right? The market was in a bear market there. Leading up to those 4 losing trades, as you can see, they were all relatively modest, wouldn't you say? 11%, 13%, 11, 14%. Those aren't horrible losses. Leading up to that, it had been on a 21 trade, 35-month winning streak. And then the 2022 bear market created the top of the market. It had a few losses. And then since March of 2022, hasn't had a losing trade. That's 11 trades over the last 13 months. All right. So when I say surprising in the title, I have to admit that it surprised me as well. So the other thing you're going to see and learn is that when you can be this consistent, the gains add up. All right. Now, for most of you who are familiar with market gauges, or anyone who's here for the very first time, if you are, just say first time or second time. If this is the first time you've seen an algorithmic model from market gauge, you could say first time. The reason I'm saying that is because if you're familiar with market gauge, oh great, welcome. Quite a few first timers. All right, well, where I was going with that is market gauge, which I'll get into shortly, are very much about managing your risk and believing that it's more important to be able to generate consistent returns that outperform the market without taking a larger risk than the market. Because if you can do that, then you can let your profits compound easily, less stress, and it's just much easier to do it when you're not worried about what your next trade is going to be. And those trades add up, right? So during the time that we're looking at, since 2018, the SPY is up about 68%. What I'm going to show you, a basic system with absolutely no leverage, doubled that, up 142%. Add a little leverage to it, now you're up to 434%. And if you add the TLTs into this, it pushes it up even higher, up 582%. Now, I'm going to show you a system that you can trade, as I've just kind of demonstrated, with leverage, without leverage, and also with options. Now, the options will have 2 different approaches. One is conservative, one's aggressive. How many of you trade options? If you trade options, just say options. If you trade both, ETF and options, maybe type in both. That would be helpful for me. Awesome. So a lot of boths. And I did see some of the data. I appreciate everybody who gave me that feedback leading up to this presentation when you opted in. We are going to cover both here. If you are new to options or don't trade options at all and you're interested in options, this is going to be a really easy way for you to get started. If you're not interested in options, it's, well, I would say quite okay, considering that even without options, you can beat the market by 6 times. Options always give you the opportunity to beat it by significantly more, but there's definitely more volatility in those different portfolios. So there's more volatility, in the aggressive, which is up 4,700%. That's in the last 4 years, I guess 5 years, including this year. But that's not a very large amount of time to be up 4,700%. Just trading one or two ETF. Thanks for the typo. I'll check that out. So options, ETFs, and it's incredibly easy to do. All right, so for those of you who are here for the very first time, it's important that you understand that while I'm doing this presentation, I'm not the only one here. MarketGauge has been building models like this and trading for decades and teaching other traders how to trade for literally decades. We started MarketGauge in 1997, Keith and I did. At the time, we were trading at Millennium Partners, a hedge fund. But before that, we were floor traders on the commodities exchange, as was Michelle, who's also a partner now, Keith's wife. Keith and Michelle had been trading on the floor since the 1970s. I joined Keith in 1990 on the floor. And then in 1993 or so, we went to Millennium Partners, which is one of the biggest and most successful quant-based hedge funds still today in the US. And that quant-based experience really, I would say, rubbed off on us. And ever since then, we've been really focused on being extremely methodical, rules-based, and even quant-based. I mean, we were doing neural networks, quote unquote, AI back in the early 90s there. And believe me, we were not the only ones. So ever since then, we've developed numerous applications and trading systems and tools that have been used by both professionals and individuals. In fact, many of our systems right now are being used by RIAs to manage their clients' investments. So if you are an RIA or a professional and you're interested in using our systems for either your clients or your home office, please get in touch with us. You're going to get Rob's number later in this presentation. Just to be clear, the opportunity here is for retail and individual traders only. So if you are a professional, please give us a call, and we'll talk about the services we offer at the professional level. Now, we've also been, Mish especially, sought after by media outlets. You may have seen Mish on any number of Fox shows, on CNBC, on Bloomberg, Yahoo Finance, TD Ameritrade. She's on about a dozen different places, are regularly calling her to be their expert, their stock picker. She really is able to fill all the roles of an expert on media. Now, it's important to us that we're not just a internet-based, faceless website. We really pride ourselves in not only being accessible, but also having live components to all of our services. So please do not hesitate to get in touch with us if you need anything, whether it's related to what I'm going to present here or anything else. Well, obviously, we can be reached by email, info@marketgauge.com. The best way to get us is typically live chat. It's at the bottom of every page. Even if it says offline, I would leave a message that converts to email. That's the easiest for us to see. If you've got any questions about your account, give the office a call, 888-241-3060. If you want a free strategy call, we're going to talk about this later. Give Rob a call. He's our chief strategy consultant. He knows all our products and he knows how they work together. You can have a conversation with him about the way you trade. He trades with a lot of our products. And this is his cell phone number, 407-770-7637. So give him a call, send him a text anytime you want, or just schedule a call with him. marketgauge.com/call will get you there. All right. So For some of you, this might come as a surprise. Others, if you're familiar with marketgauge or you've been trading for a while, maybe this won't come as a surprise. We're only going to talk about trading the SPY and a little bit of TLT. Like TLT is optional here. I didn't think about this before, but a natural question would be, what about trading the ESs, the E-minis with this? I don't know. I mean, certainly you could, but I don't have the data, and the returns would be insane because of the leverage. I'm going to check that out. Anyway, we're going to focus on trading the SPYs for the most part, TLTs a little bit. We're not going to talk about the Qs. We're not trading the Qs. Now, this may seem a little strange, and in fact, it is a little strange, because if we were to take the same exact signals and trade the Qs with them, you'd get good results. The results wouldn't be quite as good as what I'm going to show you with trading the SPYs, but they would be good. I mean, I've already shown you the results that you get with the SPYs, so no surprise there. If you don't think those are good, they're going to get a little bit better, but not much better during the course of this presentation. So why don't we have the Qs here? Well, because what I'm going to show you in a few minutes is how we're generating these signals. And when you see that, you'll understand that why we don't want to take the SPY signals right now and just tell you to trade the Qs. Again, you could if you wanted to, but there's really, historically, it's not in your benefit. We are still working on the Qs and with the specific data that we should be focused on with the Qs. So why the SPYs? Now, this would also apply to the Qs, but why the SPYs only? Well, the idea of this system is that it should be really simple, and that we don't want to have to deal with company-specific risk. When you're trading the SPYs, you're trading the S&P 500. Could there be bad days in the SPY? Yeah, there are bad days in the SPY when the whole market crashes. But you don't have to wake up every morning and wonder whether or not one of the stocks in your portfolio is going to have some random unexpected news. Or you don't have to wonder every quarter whether or not your stock's going to get clocked because the earnings announcement didn't go as planned. The other great part about trading the SPYs is that when you're trading the whole market and you can do it successfully, you don't have to worry about figuring out how you're going to catch the next hot thing. It's always going to be reflected in the market. And if it's not reflected in the S&P 500, then it's not really that big. I mean, maybe that's a little bit of an exaggeration, but for the most part, the major moves or major themes, AI, for example, or a shift in Fed policy, or if peace were to break out and the markets were to explode on that, or if there's going to be if there's big news in the semiconductor industry or any big industry, even if it's the oil industry, you will be able to catch a lot of it just by being on top of the SPYs. Now, if you've been with us for a while, you know we have a sector product, so we're definitely big believers in being able to catch specific themes with the sectors for sure. But trading the SPYs will keep you on top of the biggest themes. Again, AI being the best example of that right now. The other thing that's great about trading the SPY or the S&P 500 is that it's really easy to leverage. I'm going to show you how we do this with leverage ETFs. It's also really easy to trade options on the SPYs because they're so liquid. You have so many strikes. It's just a great market to be trading with leverage. And now the other huge benefit of having a system that works really well at anticipating which way the market's going to go, in fact, works so well that you're able to make money and beat the performance of the index by trading the index, is that means you've got a great market timing system that you can use for your other trades. I know that I get much more aggressive in my individual trades when I know that what I'm about to show you is really bullish. All right. So if this particular system turns bearish, then I'm going to get more conservative, more defensive with my other individual stock trades. Now, lastly, we're also going to trade the TLTs. So the reason we're going to trade the TLTs is because it provides a good hedge, and it also provides good diversification at certain times in the market. Now, to be completely transparent here, the TLTs were a huge, huge benefit to this system leading up to 2022. Why? We were in a 40-year bull market in bonds. So the TLT trades as part of this system, when you layer it in, make a big difference. They're definitely an important part of performance historically. Now in 2022, I probably don't need to explain to you that TLTs didn't provide a hedge for markets going down, for stocks going down. Now that's not unusual. Markets are going to go through periods where the stocks are selling off because the interest rates are going up or bonds are going down. It just so happened that 2022 was one of the worst years in decades in the way that happened, but it's normal for markets to go in and out of that type of correlation. So what I'm going to show you is the opportunity to either include TLTs in your application of this or not include it. And the reason we're doing that is because there are people out there who have kind of given up on the TLTs and given up on the bonds. I think that's completely the wrong thing to do. Yes, we've got inflation. Yes, interest rates are higher, but TLTs and the SPYs are going to, and have already at times, come back into that relationship where if stocks get hit hard, TLTs will be the place where money runs to safety, and TLT then becomes a great trade in an environment of falling equity prices. Now, it doesn't mean that TLTs have to go to the moon and interest rates have to go negative again in order for them to be a great trade. In fact, completely outside of the scope of this presentation, there's a huge real motion divergence in the TLTs. So for that reason, completely unrelated to this system, I think we're going to see a very bullish run in the TLTs if it clears its 200-day moving average and moves higher. There's a good chance that this model will pick up on that, and that could be a great TLT trade in the, I'm going to say the near term. I don't mean the next couple of days necessarily. So that's why we're trading the TLTs. You're going to have the flexibility to not only see how it impacts, but whether or not you want to include it in your use of this system. All right. So why did I say in the beginning of this presentation, even title the presentation, that this is a new discovery in underappreciated data? I think I've just shown you what I meant by a surprisingly successful system, not only because of its absolute returns, but because of its ability to be consistent in its winnings. But the underappreciated data part of this is really the edge here, and it's the market internals. So I would imagine that quite a few of you know what I mean when I say market internals, because if you've been around marketgauge for any length of time, you've probably heard of our product called Big View. And Big View is all about market internals. What you may not know is that marketgauge isn't really the name of our company. Our company name is officially DataView. But marketgauge was our first product, and the marketgauge product was the origin product of what is now Big View. The idea of this product was we compiled about 20 different pretty much market internal indicators and put gauges on them and broke them down into short, intermediate, and long-term time frames. And the idea was you would look at this one screen. This was back in the 1990s, where we had these little boxes for gauges, because that's about all you could display on the terminals. And it was all about market timing. So we've been looking at these market internals for a long time. Market gauge is was originally a measure, an aggregation of market internals. So what are market internals? Well, I'm really consolidating what market internals are with this list, but this definitely gives you the idea if you're new to it. They're basically, and what I want to emphasize when I say market internals, I want to emphasize the fact that we're looking at individual either stocks or sectors or options, and then aggregating the data based on that in a way that's different than just trading the price index. So an example of this would be looking at the number of advancing and declining issues. It would be looking at the number of 52-week highs, the number of 52-week highs relative to 52-week lows. So we take these data and create indicators out of them. Those would be market internal indicators. Up, down volume, meaning the number of the volume in stocks going up versus the volume in stocks going down. Position of price relative to 50 or 200-day moving averages. In other words, what percentage of the S&P 500 is over the 50-day or over the 200 or over the 10? If you're familiar with Big View, these are, and I'm going to show you examples. These are all indicators and measures that we have in Big View. We also look at option pricing. And when I say option pricing, I'm not talking about anything that is crazy. Even if you just look at the VIX. VIX is a measure of sentiment that's based on how much options traders are willing to pay for specific options. That is a real measure of what people are willing to pay for their fear or their greed. And it's done, again, at the individual option level and then aggregated. You could also say that the interest rate structure, the yield curve and yield spreads is part of market internals. So if we were to call market internals all kinds of information that is not specifically the price action of an index, that would be a good representation of what we mean by market internals. So these things have some pros and some cons. First of all, let's look at some of the pros of looking at market internals. Why would you want to do it? Well, for one, it gives you a totally different perspective than price action, right? You could have market internals that look really bullish and have the price action of the SPYs going down, or vice versa. So one of the things that we're always doing when we look at market internals is looking for patterns or indication that the market internals are confirming what the index is doing. Oftentimes they'll give you an early warning. I'll give you some examples of that coming up. And what's really powerful about this system that I'm going to show you is that the entry points from this system, because they're based on market internals, are sometimes some of them really made my head spin. When I first saw them, I had conversations with James, and about the conversations were about, well, do you think we should, add more of a component of the price action of what the index is doing into these entry points? By the end of the conversation, though, looking at the results, it seemed obvious that the answer to that would be no. Let's not mess with it. We have systems that weigh the price action heavily in terms of whether or not it's an entry price entry yet. And in this particular model, we don't. So you're going to get very different entry points. I showed you the performance in the beginning so that you wouldn't be sitting around wondering whether or not this craziness actually works. It's not crazy at all, as you already know. All right, so it'll give you confirmation when things are going as you'd expect. It'll give you early warnings that things might change, and it's going to give you completely different opportunities to enter the market. So I could spend a 45-minute webinar just showing you all the nuances of Big View. If you don't know what Big View is, it could be for a couple of reasons. One, right now the only way you can get Big View Premium is if you have a premium membership of another product. There is a light version of Big View that's available. This may be one of the charts that's on it. And if you have the premium version, every week, Keith does a video where he highlights different indicators, different situations, and explains why we're thinking what we're thinking. But one of the things you'll notice if you use Big View, and you'll notice as I am about to explain it, is that the thing about market internals has always been that they work great as a discretionary tool for confirmation and doing all the things that I just described. But it wasn't until now that we were able to convert or create an algorithm that would give us such amazing entry and exit alerts. Now, in our defense, what makes a good system is not just finding a great entry, it's having great tactics for trading that entry and having a strategy that is the right strategy and having the right tactics for trading that strategy. And over the last couple of decades, we have come a long way with the strategy part of with the tactics part of this. So the discovery here, the big discovery here was being able to take data like what you're looking at here and actually have the algorithm boil it down into reliable entries and exits. Now, before you even have a reliable algorithm to do this, the data is still extremely valuable, especially at key turning points when it does stuff like this. So one of the ways you would use this particular chart, this is looking at 52-week highs and lows. The chart down here, the red bars, red histogram is the total number of 52-week lows for the day. The green is the number of 52-week highs for the day. And so one of the ways you can use this data is simply to look at the total number and then look at whether or not that number is getting better or worse as the market exhibits its own patterns. So a good bottoming formation pattern is one where you get a new low or a double bottom low and dramatically fewer new lows at that second bottom, which is exactly what we saw here. Now, even better would be when it starts to lift off that bottom, you get an explosion of new highs. Now, I'm not going to call this an explosion of new highs, but 100 new highs, that's new 52-week highs, right after you had this many new 52-week lows is definitely a bullish indication. And as you can see, we had a fair number of new 52-week highs happening as the market was hitting its lows, lows for 2022. This is not congruent with a market that wanted to go much lower, which is what a lot of people, I would say the majority of people were looking for the market to do at that point. So from a market internals point of view, just looking at the new high, new low numbers themselves, if you knew what you were looking for, this was a heads up that the market indexes may not look that good, but underneath the hood, there's some strength building. Now, another way that we look at 52-week highs and lows in Big View is we take averages of the relationship between the number of new lows versus the number of new highs. And one of our very first indicators with respect to this, it was to look at that new highs versus new low number and look at it relative to whether it was below a 20% or above an 80%. And a simple way of looking at this is once you've come below 20%, you're pretty oversold. The market can go down for a long time when it's down there. So this is not a indicator that you look at and say, well, it's down here at 10%. This is oversold. I have to buy it. That's not the way you look at it. You need to see it get down below there and then start to come back up. And the thresholds are the 20 level, the 30 level. Once you see that, that generally indicates that you could have some, you have enough, I don't want to say momentum because it's not momentum. You have enough kind of support from the individual stocks out there that could drive the market higher. And again, it's not clean when you're just looking at it like this, but it did work, right? This represented it totally oversold. It got strong here, strong enough to believe that there's something about this market that could take it higher. It just didn't move higher, but the next sell-off was the end. At that point, it didn't go back down as low. And when it turned back up and really started to run, that was a really strong move. And it was the end of the move. Now, if we were to go back and look at July, you can see a similar pattern. It got really strong as it started heading higher, and we had a really strong move. In that case, it pulled back. Again, market internals are just one input. You always have to look at it in the context of what your price action is doing, but they can be really powerful. All right, any questions on that? I'll talk about the relationship to beta 17, Andrew, when we get to the Q&A session. All right, so another example, and again, this is the last example I'm going to use. I'm not going to try and cover all of what Big View does. I just want to give you an idea of how different the data is that's driving this this algorithm. So here's an example of advanced declines, up-down volume, the combination of this data into the McClellan oscillator. Now this is McClellan oscillator we have used in prior systems. We've used it as an indicator to let us know that it's time to be more aggressive about taking profits. But here too, the thing I wanted to point out is that we've got up-down volume here, McClellan oscillator in the middle, because McClellan is a combination of up-down volume and advanced declines. It's not the combination of these exact two indicators here. It's in fact not at all, but it is a combination of advanced declines and up-down volume that generate it. This is just a shorter term version of up-down volume ratio, and you would use this for something like this. This is a 5-day measure, so it's a quick look at really oversold and then a divergence. If the market starts to pop, you can expect it's going to pop. I wouldn't have looked at this and said, hey, this means that we're going to have a multi-month rally up to the 200-day moving average. But I would have looked at this and said, with this bullish engulfing line and this up-down volume divergence here that's oversold, this market's probably going to pop. And that would be one of the ways to do it. You get more convincing on the long-term picture when you see McClellan all the way down here. That's unusual. Here's a 10-day sum of advanced declines. That's a longer-term measure. So these longer-term ones would suggest this could be a longer-term bottom. And so that's the way that we typically look at market internals. Now, when you say market internals, one of the most popular responses to that would be, oh, the advanced decline line. And yeah, that would be a good answer. So here is your advanced decline line. But I can't tell you how many times I heard people referencing the advanced decline line in 2023 and using it to support their argument with a description of what it was doing that it didn't didn't describe what it was doing at all as far as I was concerned. So the problem with the advanced decline line is that the interpretation of this is just so wacky and vague from person to person, that it's always been hard to really pin down. And actually, that's why we spend more time with Big View focused on indicators that have taken advanced decline data and, in my opinion, made it more useful. But for the purposes of this conversation, the advanced decline line is a really powerful tool if you just don't try to use it. Again, in my opinion, if you don't try to use it as it's going to always be there to give you a good indication. Instead, my recommendation would be only use it when it looks really obvious. And so one of the ways it can look really obvious is a major divergence. We didn't really get a major divergence down here at the October lows. Advanced decline line just kept going down. But we did get a really interesting divergence here when the SPYs were kind of going flat and advanced declines was getting worse. Now you might say, well, wouldn't that suggest the price is going up, advanced decline line is going down? That's not bullish. I agree. That's not bullish. That would be a good argument for someone to say, if the market rolls over here, nobody should be surprised because it's actually getting weaker underneath market internals. That would be true. I would agree with that, but it doesn't break, does it? It starts to head higher. The real value here in the advanced decline line, from my point of view, is that when this market starts to break out, this change in the advanced decline line is a confirmation. We talked about confirmation a couple slides ago. So this would be an example of market internals serving as a confirmation that this breakout wasn't just the Magnificent Seven, which is pretty much what everybody was saying all in here. It's just, this market's not going up. It's just 7 stocks that are going up. And while that had some evidence down in here when this was going down, I would have argued it's not as true as they're saying, and I would definitely have argued right here that no, it's not that true. All right. Now I know there's plenty of data that would suggest that it was the 7, and yes, the seven biggest stocks contributing the most to the actual value of the index going up. Yeah, that's true. But they are the highest market capitalization, and it's a cap weighted index. That's the way it works. But the more important thing than that, even though that's what the media is all focused on, was, is there any real strength in the market that is going to keep it going higher? And I don't need to answer that question for you because the market has gone dramatically higher since, and the advanced decline line has moved higher. So the rest of the market was getting stronger. It did broaden out, and the market kept going higher. And that was really the question everybody needed the answer to. They weren't, in my opinion, focused on the internals in the right way. But to everybody's defense, market internals are as much an art as they are a science. Right? Now, I'm here to tell you that we've taken it from an art and figured out the science. You don't have to believe me. I'm just going to show you the results. All right. So are there any questions about market internals and what they're all about? Because what I'm going to do now is I'm just going to go inside this system that we call Profit Navigator. And I'm going to show you what the trades look like, what the performance has been, answer any questions that you may have about it. I know this is perhaps a little bit different than a normal webinar. I don't usually spend potentially as much time as I'm about to going through the trades themselves, but I can't give you the formulas from the from converting market internals into the models. And this is an unusually broad product. And what do I mean by that? So this is just the homepage of the product. There isn't anything that's going to impress you here. And it's broken down into 2 pages, open and close trades and performance and stats. And we've got, as I said, ETFs and options. So I'm going to go to the performance and the stats to get started. And so you'll be able to see how it works. So when I said earlier that we just trade the SPYs, but maybe the TLTs, it's because this is how we've broken it down. If you just want to trade the SPYs, and this is the chart that I showed you in the beginning of the presentation. This is the blue line that outperformed in the, no, sorry, I used the TLTs. So let's come back, I'll come back to that. So the TLTs were helpful in the beginning of the pandemic. So that's why it was actually making new highs. But you can see the other reason that it was making new highs is we didn't have any stocks. So if you were only trading the SPYs and you weren't using any leverage, when the market collapsed, we were out of the SPYs and the market collapsed. And then here, if this goes up, that means that we got in and we stayed in for a long time. Now, this particular model is, and when I say this particular model, whether you're trading the 1X or the 2X, we're in the market about 79, 80% of the time, but we're not in the market 100%. So I'm going to get to that in just a minute. But you can see that you have a choice. If you were to just trade with the 1X, there's no leverage, and you can see it outperforms the market. You can see the numbers itself here, 143% versus 70% for the SPYs. And so if I were looking at this, I would be thinking, okay, if I'm really concerned that the market's going to sell off, then I have this profit navigator. The way I can get conservative is I'll just dial back my leverage. And instead of doing the 2X, I'll do the 1X. And I'll show you why in a second. So you can see that the drawdown here, as I said earlier, ended in about March for the 1X. And then by, I guess in here, by November, this thing is making new highs when the SPYs are just coming off their lows. Now, if you want to get bullish, then you're going to want to get more. If you want to get more bullish, all you have to do is decide, well, I'm going to trade with the leveraged. Now, the way this system works is everything's based off of the non-leveraged alerts. So if we get an alert on the 1X, it's going to be the same entry for the 2X, right? Just that the 2X moves twice as much. The TLTs is a different animal in the sense that it's trading the same SPY trades, but when there's a TLT trade, which isn't based on internals, that's based on different intermarket relationships. So TLTs themselves have a different reason to enter or exit. And again, that introduces a diversity there as well. So if 1X is this stable, excuse me, and when I say this stable, you can see percent wins here, 80%. And you can see the largest loss, 7%. Total largest drawdown, only 14%, where the markets had a 34% drawdown. Now, granted, this thing makes its money because it's right a high percentage of the time. If we look at it on a year-to-year basis, so in 2018, it about matched the markets. Both were down. If you remember 2018, they basically tanked right at the end of the market. 2019 underperformed a little bit. 2020 dramatically outperformed. 2021 underperformed a little bit. And that's not surprising considering the market itself just never sold off and just kept going higher. Unless you were absolutely in it the whole time, it would have really been hard to beat it without using leverage. 2022, I'd say we killed it up on the year when the market had a terrible year. 2023, we're keeping up with it, down a little bit. But again, 2023, I don't need to explain. This thing had, the market's been nothing but up. There haven't been many opportunities to outperform by not going down. Now, if we go to the 2X, where it's dramatically different is that it just hyper emphasizes any catching of good moves, which I just showed you in the non-leveraged. It does a great job at keeping up with markets that just keep going. And it does an outstanding job of not getting crushed by the markets that go down. But, right, if you were, this thing was on a tear and then 2022 came and you're leveraged, right? So it's still bottomed out in March, right? It has the same pattern. It bottomed out in March. It just had kind of further to fall. And so its largest drawdown is 26% instead of 14. Now, keep in mind, that's still a heck of a lot better than 34. And your drawdown was through March. After that, you didn't make any more new lows. I mean, how would it have felt in 2022 to know that anytime after March, at least you could be saying, well, it hasn't gotten any worse for me, even though the market's gotten worse. And then in October, November, where the market still looks terrible, you're looking at new highs. And 2023, it's been off to the races. And so when you look at that in terms of year by year, not surprising we underperformed in 2018 because the market wasn't down a lot. I mean, this is only down 11%. That's almost a good month for the 2X. As you can see, the next year, 2019, came roaring back, dramatically outperformed the market. 2020, forget it, up almost 100%. And not only up almost 100%, but look at how it acted when the market collapsed. Because remember, it didn't get caught by the market selling off. All right. 2022, I would say, again, killed it. We were up when the market was down. In 2023, even though the market's up huge, this thing isn't just beating the SPYs, it's keeping up with the NASDAQ, which has been absolutely historic. So that's the value of leverage. Now let's just quickly introduce the idea of bringing in the TLTs. So when we bring in the TLTs, they, as I said before, with interest rates going down, they take already great performance, and the TLTs have great trades themselves. And so you can see not only was it the right place to be leading up to the pandemic, but when the pandemic hit, bonds went through the roof, and we were long, and so that is why this popped higher. I mean, I don't know how more impressive it could be to know that 2022 was a disaster year for bonds, and yet the model that had bonds in it didn't get crushed, right? Now, one of the reasons for that is because the way that the bonds work is that they do consider the price action. So if bonds are going down in a meaningful way, these things are going to get out of the way. We're not just getting into bonds because stocks are going down. That is not at all what we're doing. Right now, add a little leverage to this, and this is actually the best performing model. And that is in part and admittedly because we put some leverage back in prior to 2020, and this thing was just a monster. But you can see even in the recent periods since the high of 2021, this is completely taken out that prior high and run much higher. And this is in a period where bonds haven't been friendly. So when I said earlier, I think people who have felt like it's time to write off bonds, they're wrong. They're wrong. Bonds will have their place. The model is a way that you can do that. We're giving you the flexibility of deciding how to or when to choose to include bonds or choose to include leverage or not. And it's as easy as picking any one of the four models. And as I said before, moving between these models is really straightforward because the SPY trades in the TLT model are the same SPY trades that are in the 1X and the 2X. All right, any questions? All right, so that's how the performance looks. Before I go to the options side quickly, open and closed trades, let's take a look at the open and closed trades. You're going to be able to see what are we looking at here. So we're looking at the SPY 1X. You're going to be able to see all the closed trades going back to 2018. So if you look over here in the right-hand column, that's the performance. So you can see how consistent this thing is. Now, we're not trying to get triple-digit winners in any one of these. If you want that, I'm going to show those to you in the options. This is no leverage, TLTs, and SPYs. Again, this more than doubles the performance of the market with half the drawdown. If you want to add a little leverage to that, you got the it there. Oh, the other thing I should highlight is that you can open up these trades. And so let's talk about how this particular model works. So we've got, unlike most models and unlike all of our other models, we're not only scaling out of our position, but we're scaling in. Now, the easiest way we felt to be able to enable you to follow a model that we could get into a position and then add to that position was to break it into two pieces, two SPY pieces. TLTs were either going to be in or we're not going to have two entries in the TLTs, but we might have two entries in the SPYs. And each one of those entries has 3 potential exits. So the way to make this as easy as possible to manage is that we've got 1 entry and 3 exits for that entry, and a second entry and 3 exits for that entry. Now, what this winds up doing is it really winds up putting you in a position of a really proficient, disciplined, professional trader who would tend to not buy everything they want to buy all at once, and instead buy more as they get more confident, take profits as it moves in their direction, reduce the risk if it starts moving against them, and you will get this ebb and flow in managing your profit navigator position. But for simplicity's sake, all you really have to do is look at I have basically 3 bullets or 3 legs of a SPY 1 position, 3 legs of a SPY 2 position, and we're telling you exactly where your stop is on each one of those particular trades. And then if you want to add in TLTs, you can do that, and everything's explained. Right now, that's why down here these different positions could have more than one target. So these are the average. This is the return for the whole trade. You'll see this one says the return is 10, but the first target we were at 6.8. The second one was 12%. Right, so you get bigger moves than just the 10. Right, and that's no leverage. All right, so it's it's very different in the way we're managing the position. It's much more sophisticated. It's much more fluid. But as we believe, it's as easy as any other model. Everything's laid out for you. Now, if you want to take the same basic idea and apply options to it, here's all it takes. Let's go to the performance charts. Now, there's a big difference about the options, and that is that we have one entry and one exits. We do that because we have found that holding on to the options trades beyond the first target on balance doesn't pay. So the option trades, when I say they're simple, they are really simple. It's we're in and we're out at one target. Now, this particular equity curve, to be completely transparent, is a closing equity curve, which means that we record the price when we get in, we record the price when we get out. The interim is not recorded. Now, what this does still show you, though, is the incredible run of, in this case, you can see we had one losing trade here from January 20, actually, if I go here, from March 2020 up to September 2021, the only down move was this one right here, right? So it just ratchets up. Now, these options are much more volatile, so that you're going to have bigger swings here. But again, we can take a look at, now this is the SPY, this is using both SPYs and TLTs. Oh, I'm not in the closed position, sorry. But again, you can see the annual performance here. Now, I also have to say that the way that we're calculating your performance here is we're assuming that you're not taking 100% of your options portfolio and applying it. I think we're assuming 20 or 25% of your options portfolio at any one time. The reason we're doing that is because drawdowns would be much bigger. Now, your performance, your winnings would be much bigger if you just took 100% of your allocation here and put it in every trade. But the volatility in that would be insane. So we don't suggest it, and we're not representing it. But if you were to just look at, and we'll go to closed positions in a second, you can do it however you want, but that's how we're doing it. The important thing I wanted to show here was just, again, the consistency of the trades as they work out, even with options where you're only taking the initial leg of the trade. Again, the performance is, I mean, this is conservative. Conservative means you're using a higher delta, and this is up almost 10 times what the market, and that's the conservative strategy. If I go to just trading the SPYs without the bonds, this is not up as much, so you can see the bonds helped in there, and then again they helped historically, and they probably hurt a little recently. If I go to the SPY aggressive, again, this is a lower delta. So when you're right, you can really be right, and this is where we get the 19%, I believe, or no, sorry, the best performing one is SPY and TLT aggressive, right? But if we take TLT, which is which juices it, take that out of the equation, you're still 70% for the market and 1,500% for the bonds. I mean, for the options. And just to give you a sense, again, to go to the closed positions, this will give you a, if I just scroll down here, what are we looking at? This is the SPY TLT conservative. You can see that there's nothing to unpack here because this is going to be, I mean, it'll let me unpack it, but it's the same. It's one in, one out. And you can see these are what I would call for options kind of base hits. The basically, I would call them 10 to 50% winning returns. Not bad. I mean, you'll get an occasional 100% in there, but that's not not going to be typical for the conservative approach, again, because it's a higher delta. But if you're looking for more aggressive, if we just go to the SPY aggressive here, on the aggressive side here, you can see you got more of the over 100% winners, and you can also see with aggressive, you're going to get some wipeouts, and that's why if you're trading options and you're looking to do this systematically, you do not put 100% in, all right? Because your volatility is going to be high. All right. So that's now you hopefully understand what we're doing with this, how we're doing it. You'll have access to all the options, all the ETFs. And again, you know, this stuff I'm not going to go through. This is just helping you get started and answer any questions that you may have. So I'm sure you're probably wondering, what does it take to become a member? Just to first aggregate what I just showed you, if you're focused on the ETFs, your leveraged SPYs with TLTs returns are almost 10 times what the SPYs have been. If we look at just trading the SPY 2Xs, talking about 400% versus the 68%, and no leverage at all, you're doing twice as good as the market with half the risk, using about 3/4 of the max risk here with 2Xs. And then options, they blow it out of the water. I didn't go to the max drawdowns here, but the max drawdowns here are higher. Like this might be a 40% drawdown in the options side, but you get, like I said, you get more volatility on both sides of that. All right, so how does it work? As I said, with this introductory offer, we're just rolling this out now. You're going to get access to everything. I don't know if it's always going to be that way, but it will be right now. The annual value for options and ETF, everything all in, is $29.97. As we do with all of our models, we've got a monthly coaching, and that monthly coaching is all about this model. We introduce what other mechanical models are doing, so that you get to really get a sense of different ways you can trade mechanical models. And with the live coaching, that's your opportunity to get any questions you have answered about this model or any other models. So to us, the value of that is at least $200 a month, and that's why we put it at $2,400 per year. So the total value of this Profit Navigator for 1 year is $5,500. So, and as I said, you get the special monthly mentoring. Now, in addition, as part of this package, we're also going to include BigView. So I gave you a taste of what BigView did. I didn't even go into the gauges that BigView has, and the gauges help give you and now if you've got Profit Navigator, you're going to have another representation of how bullish you should be, just based on essentially how much of your SPY position is long. That in and itself could be used as a gauge. We haven't converted it to a gauge, but believe me, we have looked at it. It could be a gauge. But BigView, again, has all the market internal indicators above and beyond what we're using in the algorithm. The algorithm is really specific. Like I said, I don't want to call it a diamond in the rough, but the discovery here was well, surprising to be able to finally figure out how to take specific market internal data and patterns and nail it down into great alerts. Big View is worth so much more than that. And as a discretionary trader, as I said, we've been looking at it for 30 years. It's what started marketgauge. So it's incredibly valuable information. But honestly, probably the most valuable part of it is that every week it gets summarized for you in written form with bullets and summarized in a video by Keith. And if you want him to cover something in the video, send us an email and he'd be happy to include it in the weekly video. So Big View as a bonus has a value of $2,300 a year. So all in, the value here is over $7,000, $7,761. Now, as we do with all of our products, we've got a double guarantee. The first guarantee is that this system has to be profitable for you in your first year, or you get the next year free. Right? That's pretty straightforward. We want you to be making money. Otherwise, the next year is free. And the other guarantee is a satisfaction guarantee. So we know that not every model, every system that we have is for everyone. And we want to make sure that you're in the one that works the best for you. So if you give this a real try for 6 months and decide this just isn't for me, we will let you take the entire investment of this model and apply it to anything else we have. All right. So that's, I'm not saying you use it for half a year and then it gets prorated for something you're only going to get a half a year on. We want to make sure you're satisfied. We want to make sure you get at least a full first year of whatever is going to work for you. So you've got a performance guarantee, you've got a satisfaction guarantee, and you've got a special price offer right now. So right now you can get the annual membership for Profit Navigator for just $14.97. All you have to do is go to marketgauge.com/navigator. If you want to give Rob a call or Rob a text, 407-770-7637. If you are an Alpha Rotation member, please do call Rob because you will get a special opportunity right now as an Alpha Rotation member. So full year is $14.97 per year. But as we like to do, if you can see how you're going to want to use this for more than 1 year, as most people do, there's a VIP membership. And a VIP membership means that you'll pay a little bit more upfront. In this case, not even the equivalent of 2 years. And by doing so, you'll save $1,300 a year because you won't pay $14.97 per year. You will pay only $197 per year. So if you make a VIP, which is a lifetime discount, is a $24.94 investment right now. But again, that will then save you $1,300 per year. Now, I absolutely do not expect this $14.97 number for everything to stick. This is the first time we're rolling this out. And as we normally do when we roll something this exciting out for the first time, we have a charter membership. So because you're here, you have the opportunity to be a part of that. Again, all you have to do is go to marketgauge.com/navigator, and everything about the offer and the opportunity is there. You can also, as I said, schedule a strategy conversation with Rob. You can do that by sending him a text here at 407-770-7637 if the phone is busy, or marketgauge.com/call will get you there. Or just go to the marketgauge.com/navigator, and you'll find an opportunity there to be able to schedule a call. All right. Are there any questions? There were some. All right. Oh, so we do have some. So Dan, I saw, Dan, your question about TLTs. I wanted to make sure I had it. Dan, I think you came in a little late. In the beginning, I was explaining we're not doing QQQs or IWMs here. The short answer is that while you could take the same exact alerts, apply them to the QQQs, the market internal data that we're using is specific to the SPYs. And we believe that when we really focus on the Qs and use Qs-based market internals data, we're going to get better results. So rather than put out a model and change it, this is SPYs only. So there, Andrew, your question, as an Alpha subscriber, we did put out to Alpha members what we described as a beta 17 trade alert. That beta 17 trade alert, which turned out to be a great trade, was the beginnings of the Profit Navigator. So if you're in it, the Qs, we've let the Qs really run. It right now, there's one last leg on each of those trades, and it's really over. Now, if you become a Profit Navigator member, you're going to see that the SPY trade is the beta 17 trade is part of the Profit Navigator's portfolio right now. But beta 17 is going away because it's been replaced by a much more robust Profit Navigators. We did that because we knew for Alpha members that we hadn't had good trades in 2023 at that time in the spring, and we knew that we had great historical performance in what was becoming Profit Navigators. Profit Navigator. It just wasn't done yet. Turns out it wasn't even close to done. But we were confident that this trade that had just come up could be a good one. And so we gave it to you as an Alpha member. That's how that all transpired. And that's why it's being replaced. So it will be replaced. So if you're sad to see it go, you should be happy to know that Profit Navigator is even more. So right, Michael, great question. The back testing of this is pretty much the whole duration of the calendar here. I would say, 3, 4, when March, probably around March, we had it ready to go. So since March, it's been live internally. So Dan and Simon, these are similar questions. Well, all right, so let's talk about TLT first. So TLT, the TLT alerts are the same as the TLT alerts in Alpha. They use the same ratios in order to generate those trades. The SPY alerts in Profit Navigator are totally different. So a natural question would be, well, if I have Alpha, why would I want Profit Navigators? The answer to that would be Alpha has different SPY alerts. Alpha has Qs. Alpha's Qs are going to be different. Um, and for that reason, the combination of the two is very complementary. At the same time, you could use one or the other. They're going to be different. The way I would think of using them both would be in the same way that Profit Navigator has you um, scaling into multiple positions in the SPYs. If you were to have Alpha doing that as well, you would just have a more diversified approach to trading the SPYs. It is highly unlikely. Well, we never go short in Alpha. Um, it is so we're never going to be short in one model and long in the other. And even with TLTs are used because they could be a hedge in weak equity markets, but the TLTs can have great runs, bullish runs, even as stocks are doing well. In fact, I forget the year. Well, 2020 was one of these years where we were having a great run in the TLTs before the market sold off. So stocks were going up, TLTs were going up. We were in the TLTs, and then pandemic hit, and TLTs were the place to be, and stocks were not. But there were plenty of other times where TLTs, we were long TLTs, even though stocks were going up, TLTs were going up also. So if you have both Alpha and Profit Navigator, they will work together. I would just look at them as they're all contributing to the same portfolio. So, Ron, we do not scale into the options trades. We do not scale out of the options trades. The reason that we don't is because the duration has proven historically, it has proven that we're better off taking the money and running. Simon, you were thinking about thinking about rebalance and smoothing. Okay, so that's a pretty sophisticated question. I would say yes, that if you're going to use two models, it's always a good idea to rebalance. I would say for the most part, when it comes to market gauge models, you're okay with rebalancing when you've got the cash. I wouldn't necessarily advocate that you have to rebalance an existing position. Of course, that depends. If you're totally out of whack, then yeah, maybe it makes sense to sell some off. If you don't know what I mean by rebalance here, don't worry about it. But Simon, if your thought process, which I think it was if I'm trading Alpha and I'm trading Profit Navigator, and one of them and one of those happens to make a lot more than the other one, then should I bring my position sizing and my allocation of my money into alignment? And I would say yes, that would be a good idea. Shakar, yeah, there probably will be a recording. I can never guarantee it. What's the stop loss? The stop's going to be slightly different for each of the models. One way to quickly figure it out for you here. Let's get out of the options. So it's going to be around 6% in the SPYs. It's going to be more than that with the, and so that's the 1x. And then the 2x again is getting out when the 1x gets out. And so that's going to convert to, somewhere around double of what this is. So that's going to be your initial stop. Oh, good question, Benjamin. And that is, what about the 3x? So there's no reason why you couldn't do the 3x and just execute it instead of the 2x. We really should create the numbers. It's a lot of work to maintain all these portfolios. So the 3x, honestly, the reason the 3x didn't make it in here is because 3x is really not very widely accepted and used in the professional space, RIA space, I should say. So since we do have a focus and a sensitivity to what the professional side is going to use, the 3x didn't make it in here, but I suspect that we will come out with the numbers on what the performance would be with the 3x. I don't think that we will keep track of it on a day-by-day basis, but for all intents and purposes, you could substitute the entries and exits of the 2x and do the SPXL, and you'd be following the model. Dan, thanks. Dan says you've settled into a really reasonable options allocation. Very well done. Thank you. Simon, I think I answered this question kind of. Your question was, what's the position size of portfolios for the performance stats? And with respect to the options, I believe it's 20%. It might be 25%. And what that means is that what we advocate is that if you're going to trade an options portfolio, you think ahead of time, what's my allocation? Let's say it's $10,000. Then when you take a trade, you're only going to allocate 20% of that $10,000 of whatever your portfolio is to the options trade. Now, if you get multiple positions in the options, you would wind up having more than the 20% allocation. But if you only have one position on at a time, you're going to have 80% cash, 20% allocation, and so that reduces the maximum performance. Like if we wanted the performance to look even better, we would just jack up the allocation. But the drawdowns here are pretty big. 40. I mean, let's go look at them. So max drawdown 50% on TLT, SPY TLT conservative on SPY. So this is the most aggressive model, up 4,700%, and its drawdown is 74%. Right now, that probably happened right in the beginning too. If I go to closed positions, right? So that's a big hit, and that's hard to come back from. Now this one did, because that's legit. I'm betting that probably happened right in the beginning. So if we didn't get that, these numbers would be even better. Let me go to the way to see this. To go to the closed positions, and let's go to SPY TLT aggressive. And so right when we started, we took a 50% hit, then we made 350%. So maybe it wasn't here that actually happened. It was probably right in here. This isn't in order. I'm sorry. I was just on this guy on Lincoln today. This is out of order, so it's going to be hard to tell. The TLTs are sorted by their symbol. I'll have that fixed. I think this may be the only one that's actually, let's look here. No, it's there too. Sorry. My point though is that position sizing is 20, I believe is 20%. Position sizing though for the ETFs would be 100% of your allocation. So if you're allocating, let's say now TLTs is a little more complicated, but if you're trading the ETF models, and if I go over to open and closed positions, if you're trading just say the SPY 2X, and you're allocating $10,000 to this, then you're going to allocate 5,000 to the SPY 1 and 5,000 to SPY 2. And so that's your whole allocation. With TLTs, if you want to fold TLTs into it, our recommendation is not to get too crazy with the getting all the allocation super specific unless you're really into it. The easier way to do this would be to look at the TLTs as a whole different trade. So if you're, let's say you're allocating $10,000 to the ETFs, maybe you allocate 5,000 to TLTs. The way we're doing it is we're 100% into TLTs. 100% into SPYs. If we get a TLT trade, we reduce the SPY position by 50% in order to have a 50% allocation to TLTs. Saying that's really easy, doing it is a little more complicated. The other way to look at it would be if you're using TLTs, you're using new cash on the TLTs, or you're using margin. If you want to be super precise about it, give us a call. But from a trading perspective, we find that most people, hopefully you're not using 100% of your account in this. Don't do that with any one system. And so you would just view the TLTs as a kind of a separate trade. All right, I think I've gotten everybody's questions. If I haven't, please let me know. I'm going to scroll through one more time. I'm going way past what I thought I would. Give Rob a call. Go to marketgauge.com/navigator. Great questions. Clark, congratulations. Awesome. I'm glad you're already in. And thank you. Um, so now to your questions, thoughts about trading Profit Navigator, Alpha Rotation, Qs versus Profit Navigator, ETF sectors, or gems. So this is a perfect question, and you talked to Rob already. And the question really is, what are the thoughts on unfolding in sectors or gems to using Profit Navigator and Alpha and sectors and gems? For the right person, right? If that's your level to be able to be diversified like that, it makes a lot of sense. You don't want to be overwhelmed with too many models to have it be more work than you want. And if you want help doing it, that's what market-gauge asset management is around for. But if you want to do it yourself, it's absolutely a viable strategy, and it makes sense to introduce sectors and gems. So gems, and I'm not going to go off on explaining everything that gems does, but Clark, you've got it. It was your question. Gems is looking at ETFs that cover all kinds of assets that are not in sectors necessarily, and it's not majority of it isn't the US equity indexes. So GEMS is, let's say, a group of assets that's different than sectors. Sectors is different than SPYs. SPYs, you've gotten broken down into Profit Navigator signals and alpha signals. So you've got, a well-diversified way of playing the SPYs, and then you've got sectors, and then you've got other assets. Makes total sense. Like I said, if you can manage it all, which if you enjoy trading and you've got the desire to do it, I don't think it's that big a deal. So yeah, I would say go for it. I hope that's answering your question. So how does Profit Navigator's performance compare to the Alpha Rotation performance? Alpha Rotation had trouble in 20 so here's one of the big differences in terms of performance between Alpha and Profit Navigators, and this is a function of how they're derived, is that Alpha, the way it gets into positions, had trouble in 2021 keeping up because it needed a correction to get back in, and Alpha only had one in. Like, we just get in once and then we manage the position. So while it was long in 2021, it had partial exposure or no exposure for too much of the time to really keep up with the market. So it wasn't bad, it just didn't keep up. And then in 2022 is a perfect storm for Alpha, as I said earlier, because Alpha really does depend on the bonds to be there on down markets. And it doesn't have two entries. It has a criteria that the price action of the index is very important for the entry on Alpha. And so it has different entries, and depending on what the market does, it's going to have very different entries than Profit Navigator. So 2022 is a tough year. I'm going to say a tough year for Alpha. Depending on which version of alpha, you outperformed, but you were down. Options were down, and because they were options, they got hit hard. So Profit Navigator has done great did great in 2022 because it isn't dependent on the index price action to get in. And it has two different positions, and it's managed a little bit differently. So if we go back beyond 2018, which we will do and finish up, you're most likely going to see alpha being much stronger than Profit Navigators. Keeping up with the market, doing well, but alpha will probably outperform. Recently, the last 2 years, then Profit Navigator has been better. This is why together they work. Looking forward, I would be willing to bet you're going to have years when one's better than the other, and vice versa. So this is why, and one of several reasons why Profit Navigator doesn't replace alpha. It's not an upgrade to alpha. It's different than alpha. There is a common thread with the TLTs, but that's because the TLT trades work so well that it doesn't make sense to change them, and they add to Profit Navigator. So we're borrowing from alpha with the TLTs, but the objective of Profit Navigator was, can we find a different way to get in and out of the SPYs that doesn't have this criteria of making sure that the price action in the index has a particular pattern, because that particular pattern, if the market just gets on a roll and keeps going and never pulls back in 2021, we were already concerned about this in 2021, and then 2022 came, and it was a different problem. It didn't. So that's the difference. Tim, I don't know if that answers your question completely. I think if we were to look at the overall performance historically, they might even be pretty close. It's hard to tell off the top of my head, because if I don't have the absolute numbers as a straight comparison, because alpha went all the way back to 2007, so it had a longer time frame. All right, I think I've answered all the questions. I certainly did not expect to go this long. I apologize for the 2 hours, but you guys had great questions. So I hope this was helpful. And if you've got any questions, please don't hesitate to reach out. Please do reach out to Rob before the end of the week. This is the introductory week, so now is the time to get in at this special offer. Again, marketgauge.com/navigator. You see it on my screen. Rob's direct number is here, and his number is also on the page if you go to Navigator. Thank you very much. Really appreciate all of you who have been with us, and those of you who are just joining us now. And we look forward to serving you for a long time going forward. Bye for now.